you were thrilled when Bitcoin finally got back to 90K after crashing down to 80K the other day, but in the back of your mind, that annoying little voice keeps asking the whole time, can any of this be real? Is it really over? The bears are right. 4-year cycles here. Just a bit of hoping before another rug, and it's all going to go to zero. The trauma will continue, especially now that price action has been kind of stalling a bit. But sometimes the stars could really be aligning. Not magically, but in a cold, macro-driven receipts in your face kind of way. So grab your popcorn, stick around, because if you want a shot at joining the next batch of millionaires getting minted in 2026, you need to understand what is potentially coming here. Now, Jerome Powell isn't exactly a fan of crypto. He's seen as the guy standing between us and real rate cuts. But his time as Fed chair ends in May 2026. The person likely to replace him changes everything. And at some point soon, the market's going to start front running that very narrative. The leading contender right now is a guy named Kevin Hassett. K-Hat. Lark, come on. Anyway, the current director of the National Economic Council, he's a favorite in prediction markets. He checks every box Trump wants in a Fed chair, including a distinctly dovish outlook. Plus, he was a chairman over at Coinbase, so the dude knows about crypto. Now, dovish basically means he's prioritizing growth and jobs over fighting inflation, which translates to lower interest rates, easier money, and a far more supportive environment for businesses and risk assets like crypto. The rates have been way too high for way too long in America. Inflation has not been an issue for a long time. The jobs markets are getting slaughtered currently, not horrifically, but enough to cause a lot of concern in the markets, okay? Jerome Powell is late to the game. Kevin Hassett, when he gets announced as the official appointee, will start markets igniting again. When you add in the December rate cuts, the official end of QT back on December 1st, the stealth QE vibes from that $13.5 billion liquidity injection of the overnight repo markets, you can see where all this is headed. We're lining up for what might be the most dovish liquidity-friendly Fed we've seen in years. Now, Jerome Powell has been easing. Kevin Hassett's going to be the biggest dove ever. The perfect setup, the perfect timing, the perfect storm for risk assets. Now, here's the part nobody on Twitter wants to talk about, mostly because enhanced supplementary leverage ratio sounds lame as heck. The ESLR sounds like a NyQuil flavor. But stick with me, because this is quietly one of the most bullish catalysts of 2026. After the 2008 financial crisis, regulators slapped big banks with capital handcuffs. These rules basically said, hey, come on, guys. You can't just YOLO your balance sheets anymore. For every dollar you lend or invest, you need to hold X amount of safe capital on the side, just in case you blow yourselves up again. We're not going to trust you guys like we did previously, okay? It all sounds pretty reasonable until those rules start choking lending, freezing credit, and making banks operate like they're trying to run a marathon with a weighted vest. Not exactly what you want if you want to have massively dovish vibes and easy financial conditions. And financial conditions are loose right now, but they can get a lot looser. We'll have to pay that bill at some point, but they can get a lot looser. Fast forward to now, regulators just loosened up those handcuffs a little bit, specifically the ESLR rules. It's basically like telling banks, you used to get one slice of cake, now you can take the whole cake and do whatever you want with it. Wrap it in CDOs, do credit swaps, whatever, we don't care. More leverage, more lending, more risk, more pump, more hangover later, obviously. It's not called quantitative easing, but when mega banks can suddenly lever up again, it works kind of like QE. That liquidity always finds a way into stocks, into real estate, and yes, into crypto eventually. Now, guys, real quick, have you ever wished that crypto investing worked more like an ETF? Things are a bit simpler. Well, this is your moment, because Reserve has created decentralized token folios, DTFs, on-chain, rules-based portfolios that bundle multiple crypto assets into a single token. Think ETF logic, permissionless, transparent, live on Ethereum base. It's backed by some big names, Sam Altman, Peter Thiel. Reserve has partnered up with Bloomberg, CoinDesk, and CF Benchmarks to bring institutional-grade index products on chain. Think about it. One click in, one click out, massive exposure to a different range of assets. Since launching indexed ETFs in February 2025, Reserve now offers 18 different index portfolios, including the largest, the LCAP, with over $6 million in TVL. Total TVL across Reserve sits around $400 million, growing every month as their products become more and more popular. Anyone can mint, redeem, or trade DTFs on Reserve, on chain, on Kraken, on Coinbase DEX, Uniswap, Aerodrome, and the Ugly Cash app. So if ETFs have Vanguard, DTFs have Reserve. Check out Reserve to get diversified crypto exposure in one simple on-chain token. You can go to reserve.org right now to learn more. You'll find a link down below. And of course, thanks to Reserve for sponsoring today's video. Now, let us talk about financial titans who literally control trillions of dollars. The movements don't just send ripples to the market, but rather it comes like a tsunami, sweeping everything that is not tied down away. First, Charles Schwab, one of the most conservative, boomer-coded brokerages on the planet. I mean, their name's Charles Schwab. How much more boomer can you get? They just opened up Bitcoin trading to their entire client base. This is a brokerage with over $11 trillion in client assets, managed by people who generally treat volatility the same way that they treat raw seafood, with fear and suspicion. Oysters, man. Anyway, when Schwab offers Bitcoin with the same ease as buying Apple stock, that's not just crypto adoption. That's crypto normalization from one of the most boomer brokerages out there. It signals to the entire financial system that Bitcoin is no longer a fringe weird asset. It's the hot asset, and it will not disappear like your ex after learning that you play Magic the Gathering. Then you have the unthinkable. Vanguard. These guys are absolutely massive, about $11 trillion in assets. They refused to list Bitcoin ETFs famously. We're never going to list Bitcoin ETFs. The previous CEO said it's not a store of value. Well, things have changed. That CEO got fired after they watched BlackRock make gargantuan sums of money with their Bitcoin ETF. They said, "You're an idiot. Get the fuck out. We're hiring a new guy." Vanguard's now preparing to offer crypto access to more than 50 million brokerage customers. That's crazy. They haven't slapped the Bitcoin logo on their homepage yet, but the pivot has unmistakably begun. Their clients already have the access. The reason is painfully simple. When your competitors offer Bitcoin exposure and your clients start leaving to chase performance, ideology collapses into the weight of math. The math is brutal. Bitcoin is the best performing major asset of the past decade. Oh, I know the last year it hasn't been. Gold's outperformed us. The S&P 500's outperformed us. It's a bit complicated. But do you want to buy high, or would you like to buy when prices are lower? Interesting coinky-dink here that Charles Schwab, Vanguard, Bank of America all started offering to their clients after we got down to the 80K range. Bank of America, by the way, a pillar of America's traditional finance world, now recommending that clients consider a 1 to 4% allocation to crypto as part of a balanced portfolio. That may sound tiny, but zoom out, a 1 to 4% allocation across pension funds, sovereign wealth funds, retirement accounts, private banks is not a small number. We're talking billions, tens of billions, hundreds of billions of dollars of potential inflows. Doesn't happen overnight, but over the next few years, it changes the game as a new class of investor comes in. The Bitcoin IPO moment, right? OG whales cashing out, TradFi's buying the bags. And unlike retail FOMO, asset allocation policy isn't emotional. Once it's written into the playbook, institutions follow it for decades. Then there's the funding hose. BlackRock's Bitcoin ETF is consistently posting volumes that rival and in some cases surpass major traditional ETFs for like the S&P 500 and shit like that. It's crazy. That's not crypto degens trading it. That's Wall Street money. That's corporate treasury demand. That's quantitative strategies, pension rebalancing, institutional hedging, all pouring into Bitcoin automatically. And institutions don't just buy one time as a YOLO, they buy every quarter, forever. You know, we always hear the follow the money. Well, here it is, and most people apparently are not following it, okay? The folks who are literally made of money are saying Bitcoin is here to stay. People like Larry Fink are out here saying Bitcoin's the future. And people are like, oh yeah, Larry Fink, who's that old guy? Come on. Now let's talk about the wild card everyone pretends won't happen until it magically appears in their bank account. Trump's proposed $2,000 stimulus checks. It's not confirmed yet, but if it lands, where do you think all that money goes? And people are like, well, it's never going to happen. It's a midterm year. You think Trump's going to resist sending out $2,000 checks to people with his face plastered on the check? It's Trump, guys. Come on. Think people are going to just save that money? Nah, dog, they're going to spend it. Portion of that money is going to flow into investments. Yeah, people are going to buy just boring gold and stuff like that. People are also going to buy dog coins. And while some people blame stimulation checks for inflation, we can't ignore what they actually do. The COVID-era CARES Act helped spark one of the biggest risk asset runs in history. Bitcoin ripped nearly 900% in the following year. And these stimulus checks, by the way, come from actual revenue from tariffs, not just magic money printing. Now, we might not get a similarly wild melt-up, but this is absolutely a catalyst worth paying attention to. Now, here's the uncomfortable truth nobody in Washington, D.C. likes to say out loud. You see, the U.S. needs rising markets to keep the machine running. Think about it. The higher asset prices mean higher tax revenues, stronger consumer spending, smooth credit markets, and a financial system that doesn't buckle under almost $40 trillion in debt. When stocks rise, usually crypto rises. After the 1010 crash, it's not been the case. We will correct at some point, likely to follow stocks higher. But when stocks and crypto rise, people like green candles, right? People spend more. That spending flows straight into corporate earnings. Companies expand, they hire, they invest. The whole thing forms a positive feedback loop. And the lower interest rates that we get, the better that happens. Okay, looser financial conditions through lower rates, especially if we have any kind of stealth QE in the background, really helps that too. So the people in power will do everything they can do to keep markets propped up, to keep the wealth effect going, especially with midterms next year, because a strong economy is basically the best campaign ad that money can't buy. Put everything together: liquidity returning, regulations loosening, institutions piling in, political pressure for growth, a system that literally functions better when markets rise, and the conclusion writes itself. Now, I'm not saying it'll be smooth sailing. It literally is never smooth sailing in markets. Not saying we're going to moon tomorrow. Probably not. Markets do not move in a straight line. It'll be choppy, it'll be confusing, and sometimes flat out terrifying. People will get shaken out. We'll lose many along the way. But when you zoom out, all the short-term noise doesn't compare to the macro firepower that's loading right now. I can't tell you what to do with your money. It's never the intent of this channel. For me, I'm not going to be on the sidelines for a potential setup like this. If macro melts faces, I'd rather be riding the wave than watching from the sidelines. Can I be wrong? Yes. Can I lose money? Yes. That's the risk I take investing in markets. Every time. Thanks for watching.